So on the Money Show, we make sure that we don't just talk about investing in mutual funds, but also help you meet the brain behind these funds. And in this week's Meet Your Fund Manager segment, we have on board Harsha Upadhyaya, who is the fund manager of Kotak ESG Opportunities Fund. Let's welcome Harsha on board and understand all the aspect of Kotak ESG Opportunity Fund. Harsha, good evening and welcome to the show. Let's start with the very basic question. What exactly is an ESG theme, and what does it mean? So much of thrust actually is going on in the entire ESG space, even from the regulator. Why so much of thrust all of a sudden, Harsha?
When you look at ESG funds, these are the funds which are thematic in nature, as you rightly mentioned. And the requirement from a guideline perspective is at least 80% of the investments of the fund should go into this particular theme. What is an ESG theme? It is a theme which focuses on environmental, social, and governance factors, along with the normal business and financial parameters that you would anyways evaluate for any fund. So to that extent, these are the additional factors on which there will be focus. And the companies which are rated better on ESG rating would be the ones which would probably make the cut. Obviously, they have to look good even on the financial expectations and the valuations, etc. But generally, these are the companies which also score highly on the ESG theme. So that will be the core of the portfolio, and that's how the fund is managed.
Right, Harsha, but then just to give a backgrounder, because we are seeing a lot of guidelines which are coming up from the regulator. What are the few guidelines that you would want to highlight to our viewers regarding ESG?
Kavita, over the years, there have been a lot of new regulations that have been coming onto this space, not just in India, but globally as well. As far as India is concerned, this is at a very, very nascent stage, I would say, as far as ESG fund management is concerned. And we are seeing a few guidelines coming up every a few quarters or every half year. The first set of guidelines were from 1st October 2022, when it was made mandatory that any fresh investments that we do in this particular fund will be in those companies which have published BRSR reports in the annual report. BRSR reports are business responsibility and sustainability reports, and these are part of the annual report. Currently in India, these are not mandatory reports. From financial year 23 onwards, that is when the annual reports for the past financial year would start coming into the market. This would become mandatory for the top 1,000 companies, but as of now, it is not mandatory. However, for the fund, we can only invest in such companies which have done this BRSR reporting on a voluntary basis as of now. So that's one of the guidelines that is done. Secondly, from October 1st, 2023, we will not be able to even hold companies which have which do not have BRSR reports. As I mentioned, currently only the new investments have to be in BRSR reported companies. Going forward from 1st October 2023, even if you have something existing in the portfolio and that company has not provided BRSR reports, then it will be out of the portfolio. So this is something that is going to come in. Apart from this, there have been few other requirements that have been spelled out by a regulator in the recent meeting in March. So to that extent, the conditions are getting stringent and the focus on ESG keeps improving. And that should be helpful for the investors as well, because there is so much regulatory scrutiny around how ESG theme is really focused upon in each of these funds in the category.
Right. Now, considering these guidelines, Harsha, why do you think ESG as a theme has a brighter future prospect? And looking at this area and looking at the kind of focus from the regulator, from the AMCs, even from investors, how do you actually look at ESG becoming one of the mainstream theme for an investor portfolio?
Kavita, this is simply, it's about whether you are interested in making just the money and not care about environment, society, etc., or you also want to really nudge the investee companies in terms of doing right things for environment, society, and various other factors. So that's the question. And I'm sure all of us would want to make money, make wealth, but at the same time would want to leave our planet, our society in a better shape for our next generation. So in a way, ESG funds focus on some of these aspects, which are not to be ignored at all, if you want to create that kind of an environment or society. That's where I think the prominence of ESG funds is continuously increasing across the globe, and also that governance is a very important factor apart from environmental and social factors, right? If there is not a great governance in terms of the company, then clearly the promoters or the majority shareholders are not aligned with the minority shareholders, and at some point of time, that's going to become a real risk for investors. So in ESG, when you analyze ESG factors, governance also takes a lot of prominence. So to that extent, I would say some of the issues that could be detrimental to environment, society, and even how the business is run in terms of governance could be filtered out in ESG factors. And to that extent, I would say this particular category of funds could probably carry lesser risk compared to the general equity investment that you see.
So, Harsha, explain us how do you actually construct a portfolio? Looking at your fund, what's the kind of exposure do you have across market caps, across companies that you've selected? Obviously, keeping the guidelines in mind, what exactly is your near-term outlook?
Before I talk about the current portfolio construction, let me also mention that there are no regulatory constraints in terms of either sector allocation or market cap allocation in this particular category of funds. The only requirement from a regulatory perspective is at least 80% of the investments should be focusing on the ESG theme, which I earlier explained. So as far as this fund is concerned, given that there are no constraints on the market capitalization or the sectoral positioning, this works more like a go anywhere fund or a flexi cap fund with just an additional focus on the ESG theme. Currently, in terms of the sectoral position, we do have large weights into banking and financial services and auto. These are the two large exposures in our fund. And we believe that if you look at the earnings trajectory of these two sectors over the next few quarters and next few years, clearly they are expected to do much better than the overall market average. And in terms of valuations as well, we believe that valuations are not so rich. So that's where our overweight positioning is coming into these two sectors. As far as market capitalization focus is concerned, currently it's tilted towards large cap. As I mentioned, the BRSR reports are still not mandatory. And on a voluntary basis, there are only 190 companies that have published these BRSR reports. And out of these 190 companies, majority of them are large cap companies. So to that extent, our portfolio is also tilted towards large cap. Currently, about 80% of the portfolio is into large cap stocks.
So in this current scenario, Harsha, how are these funds taxed? What's the tax treatment for these funds?
Yes, this will always have minimum 65% of equity. So to that extent, it comes under equity taxation guidelines.
So, Harsha, as we all know, and it's already established, it's a very thematic fund. Talking about thematic fund, when do you think one should actually consider having them in their portfolio? Obviously, it's after having a base portfolio ready is when you want to diversify to a thematic theme. And this being a very innovative one, do you think it's one of the themes which is a must-have in your portfolio?
Kavita, I would say the risk is similar to any other equity fund, maybe to a lesser extent, because some of the red flags that you see in other equity investments from time to time may get filtered out when you focus on ESG factors. That's one thing that one needs to remember. However, this is a thematic investment style, which means that there will be few sectors which will score on ESG parameters. So to that extent, if even the valuations and the business prospects are favorable, then the fund may take a slightly more tilted position in terms of few sectors. So to that extent, I would say it may at times become less diversified than a normal equity fund. So that could be one of the risk parameters that one needs to keep in mind. Apart from that, I would say that general market volatility would also affect this fund, just like any other equity fund, but hopefully lesser than the normal categories, simply because you have already screened for good governance, how they treat their society, how they treat the environment around their plant and offices, etc. So to that extent, I would say some of the regulatory issues that you may face in case there is an environmental issue violation or a social violation, etc. Or even if when you look at the governance, probably you will have lesser accidents in terms of misgovernance of some of these investments. So while on a thematic category basis, maybe the risk is higher than a diversified category, but since there is a focus on ESG, I would say to an extent that also gets compensated by better focus on ESG factors. So broadly, I would say the overall risk is similar or slightly lesser than an equity fund.
Mhm. So, Harsha, now counting all the factors, what you've just placed over here, what's the kind of risk that will be involved when one wants to invest in ESG theme, especially when you are in a longer term horizon investment pattern?
Yes, clearly, any equity fund that you invest into should be for longer term. So just like any other equity investment, even here we would say it should be for a longer term. And also, since it's a thematic investment, one should not be looking at investing all their equity allocation into this particular product. It should be a small proportion of the overall equity allocation. But yes, if, over a period of time, they should give a reasonably good experience for investors, because one, it'll give you equity related returns, and also will try to nudge some of the investee companies to do right things as they go forward. So that's the benefit is also there.
All right, so that's about Kotak ESG Opportunity Fund. But then, Harsha, since you are over here, let's talk about markets now. Inflation has come down, a bit cooled down though. But then going ahead, what's on your mind? Corporate earnings, or what's the trigger that will move the market for you?
As you mentioned, the latest inflation print has seen a downtick, and even when you look at global inflation outlook, there seems to be kind of a consensus that over the second half of this calendar year, it should start moderating from current levels. If that comes through, I think some of the macro headwinds that we are seeing across the globe, maybe to a lesser extent in India at this point of time, will also start going down further. If that were to happen, then I think the only other concern would be when would you see the impact of lower inflation in terms of better profitability for corporates in India. And that should also follow over the next couple of quarters. If you remember last June quarter, June 2022 quarter, was the worst quarter in terms of profitability margins, because that's when the commodity prices had really shot up significantly. This year, as we get into June and September, I think we should be able to see better profitability margins across the board for Indian corporates, led by reasonable steadiness in terms of demand, and also the factor that inflation is likely to moderate as we move forward. So overall, I think once the macro headwinds start to diminish, then the focus will definitely shift back to corporate earnings trajectory. And as of now, the earnings trajectory is expected to move at around 16 to 17% for next for this financial year and the next financial year. So if that were to come by, then I think market has legs to move further.
Last question to you, Harsha. What are the specific sectors going forward on your radar?
We still believe that domestic growth is more resilient than global growth, and inflation problems in India are much more manageable as compared to what you are seeing in the Western world. So, to that extent, while the macro problems may still continue to linger on for the Western world, India will be in a better shape. It is already doing much better than some of the Western nations. But clearly, I think as inflation moderates, it should do even better. So with that in mind, our focus has been on the domestic businesses, which also seem to be quoting at a valuation which are not so expensive. And these are the sectors essentially which are likely to see resilient demand conditions. And also hopefully with inflation coming off, the earnings trajectory should also improve as we go forward. So banking, auto, cement, and industrials, these are the pockets within the domestic economy where we have been overweight at this point of time. We continue to be a little cautious on export-oriented or global-facing businesses, simply because global growth is still a question mark as compared to domestic growth in our mind.
Right. That will be all. Thank you so much, Harsha Upadhyaya, for being on the show and helping our viewers today.